Good morning, everyone. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Rochelle Akufo. Here are three things that you need to know to start this morning. The S&P 500 joins the Stoxx 600, DAX, and South Korea's Kospi in a bull market. The rally has been notoriously narrow and driven by a handful of big tech stocks. In recent weeks, it's been helped by expectations of a rate pause at the Fed's next meeting. And the bond market is telling a different story here, of course. Yields pushing higher after shock rate decisions this week and threatening to derail the NASDAQ ongoing AI frenzy. JP Morgan says that there's a 20% downside risk for stocks if bonds are proved correct. Well, second thing, Donald Trump has been indicted for a second time, now on federal charges relating to the handling of classified documents while out of office. The indictments remain sealed, and it's unclear what impact this could have on his run for the GOP nomination, though he's still far and away the frontrunner in a crowded pack. The former president's poll numbers, they jumped after his April indictment by Manhattan's district attorney. Trump remains under criminal investigation by the Department of Justice and Georgia's state prosecutor for his efforts to overturn the 2020 election. And GM joins Ford in adopting Tesla's North American EV charging standard, solidifying the dominance of Elon Musk's technology in North America. The move was announced by GM CEO Mary Barra and Musk on a Twitter Spaces event. It will give GM's EV owners access to Tesla networks of 12,000 superchargers. Now, Tesla, GM, and Ford, they make up 70% of current U.S. EV sales. Wall Street, they were happy with the news. Shares in automakers jumped on this news.
Well, Donald Trump has been indicted for a second time, now on federal charges related to the handling of classified documents while out of office. The indictment remains sealed. There has been reporting that there are 7 charges involved. It's unclear what impact all of this could have on his run for the GOP nomination, though he's still far and away the front runner in a crowded pack among the Republicans. Trump remains under criminal investigation by the Department of Justice and Georgia's state prosecutor for his efforts to overturn the 2020 election. Yahoo Finance's Rick Newman is with us now. So first, a federal indictment for a former president, Rick. And we talked about this a little bit yesterday, what effect this could potentially have on the race. Give us your thoughts here this morning.
Well, remember what a big deal it was when prosecutors in New York City earlier this year, they charged Trump with crimes. I think this overshadows that. And as you pointed out, Julie, there could be a third indictment coming from the state of Georgia. So the analysis within the Republican Party is somewhat amazingly that this does not really hurt Trump among Republican voters. I know it seems crazy, but he retains a sizable lead in the polls. And in some ways, this seems to benefit him among his supporters. That's been a very familiar storyline. However, I think there are some caveats here. It clearly gives people running against Trump tons of material that they did not have in 2020 and that they did not have in 2016, which is he's now been charged with multiple crimes. And he may end up convicted of crimes by the time the election is actually held in November of 2024. So we know that on the Republican side, at least one candidate, Chris Christie, the former New Jersey governor, who is also a former federal prosecutor, he is going after Trump big time. I mean, he has basically said it's his mission to take Trump out of this race. You also have the former vice president, Mike Pence, who is not being as aggressive as as Christie, but he is also basically saying it's time to move on from Donald Trump. So you're definitely seeing fissures there rather than deference to Trump on the Republican side. Will this make a difference? It's unprecedented. The old refrain is never count Trump out, but I think he's weaker than he's ever been as a politician.
Rick, even as we work through the 2024 scenarios, we've had discussions in the past where you've said that the markets actually might be leaning towards hoping that there's a Biden a Biden kind of re-election, because then the markets would have something in terms of certainty. However, the other part of this equation, too, is if it's not Donald Trump that's running against Biden or whoever the Democrats put forward, then what would the markets do with that? So essentially, with this information in the indictment, will the markets react at all?
Right. So, in other words, how do we spin this forward for the markets? I think it's impossible to do right now. But I mean, put it this way: the market is fine with Joe Biden. We saw no quaking in financial markets when Biden got elected in 2020, nor when he took office in 2020. I mean, obviously, there have been weird gyrations in the markets related to COVID, rising interest rates, and everything else. But look, Biden was not so unfriendly for markets. He wanted a big increase in the corporate tax rate. That did not happen. He couldn't get that through Congress. I mean, a lot of the things that markets would not have liked about a Biden presidency that Biden would probably like to do, he can't get done because he has to get it through Congress. So this is probably a reasonably good outlook for markets. Trump generally is friendly for markets, except for the chaos factor. I mean, one of the things about Trump's presidency that markets really disliked was the trade wars. That sent markets up and down on a periodic basis. And I suppose we could go back to that. But if it's Biden, markets are good. And if it's another Republican, Republicans generally are friendly toward markets and toward businesses. So I think that's pretty good, too. So not a lot to worry about for markets here, I don't think.
All right. Yahoo Finance's own Rick Newman. Thanks so much, Rick, for setting the stage for us for what we have to watch going forward on that front. So the S&P 500 achieves bull market status, and the narrow rally is showing signs of broadening out beyond mega-cap tech. But the big question for many investors, when is the melt-up going to melt down? Let's bring in our guest host, John Authers, who is the Bloomberg opinion columnist and previously spent decades at the Financial Times. He's known by many as the writer of the Lex column. Great to have you here with us this morning, John. So help us address that big question first. In the melt-up that we have seen, does it show any signs of wavering early on right now?
It doesn't yet. I would like to say, however, that if anything gives me a toothache, it's the notion that any rise of 20% from a low equals a bull market. There's a lot more to whether this is truly a bull market than whether it happens to have passed that number. And I think, broadly speaking, yes, you're right about the narrowness. It's not unusual for rallies to be narrow, to be quite as thoroughly dominated by large companies as they are at present is strange. And it does lead you to question whether the 20% gain is permanent, whether it can be built on.
And so, John, it's Julie here. Thanks so much for joining us. It's a pleasure to have you here. So if it's, and I know there are lots of different ways to define a new bull market, right? So what do you look for? What are the markers you look for, if not just that simple 20% gain from the low? And what would convince you that it could be more sustainable?
If we had already had a recession, I would feel more comfortable about it. There's an extreme shortage of bull markets that started before the recession had even happened. They are not the same as the economic cycle, but they're linked to it. Similarly, there are, as far as I can remember, I don't think there are any recognized bull markets in history that started while the Fed was still hiking. Generally, you wait until they've started cutting. It would be strange if this was a rally that could persist despite that. The other thing that bothers me is the valuation. Generally, if you're talking about one of history's really big secular bull markets, like the one that started in 81, 82 after Paul Volcker had slayed inflation, or indeed if you're talking after the one that started after Lehman in 09, stocks tend to be really, really cheap. And really on any basis you care to mention, they're not. They weren't in October when the 20% rally started, and they certainly aren't now. So those are all reasons why I'm nervous to call this a bull market. If we avoid a recession altogether, then which some people think is a possibility, then maybe you can put down all that happened last year to this, to a very strange, very dramatic correction from an overvalued level. You could therefore say actually that it's perhaps more like the Black Monday crash of 1987. Took a little longer to unravel, but it was one of those rare occasions when you have a very sudden, very aggressive correction that's really a market event, not an economic event. I guess we might yet find out in the future that was true. In terms of avoiding a recession, if we do, and certainly the recession has taken a lot longer to arrive than many expected, then yes, I would think you probably can sustain further rises from here. You probably would, if we really can avoid any kind of a significant downturn, think that this could be a sustainable rally. Getting back to what we were saying earlier about Trump, incidentally, just note that if that's really true, if the stock market is right, then whether he's indicted or not isn't going to make much difference. If we've really still got a stock market rallying by the end of next year and inflation has come down immediately to 2% by that point, and there isn't terrible unemployment, I don't think the Republicans are going to be winning that election. Whether you find that believable or not is another question.
So, John, then in terms of signals, because as we look at this narrow stock market rally and you pair that with what the VIX is doing, and then on the other hand, you look at the bond market, what is giving us the clearest indicator of where the market's headed next?
I wish I knew. I think if you look at the bond market, it's generally dangerous at any time to ignore what bonds are telling you. And bonds plainly are showing some degree of concern that more tightening is going to be necessary, that there is we have more of a problem with inflation to deal with. That, in many ways, is good news. It does show that that there are reasons to hold stocks rather than bonds. It does suggest that there is a certain dynamism in the economy, but obviously, all other things equal, higher yields make it harder to justify higher profits, higher PEs, higher share prices. I think if there is one issue that really makes me wonder whether this is a sustainable bull, it would be earnings, corporate earnings, which have not declined anything like as much as had been expected, and earnings expectations have turned up quite significantly over the last month or two. You're not seeing margins come back down in the way that people were expecting. If it's really the case that that corporate earnings can continue to do better than people had thought, possibly due to finally managing to improve productivity thanks to AI or whatever, that would make a difference. You do, however, have to put up with the issue again. It begins to become almost a catch-22. Part of managing to maintain your margins, part of keeping earnings high, is marking up, is able to have pricing power, if you want to use the very loaded phrase that's popular these days, it's greedflation.
Right.
Therefore, it's difficult to see how you really do keep an earnings boom going without seeing rates rise higher.
Now, John, don't go anywhere. We're going to have you still continue to weigh in on some of the other topics that we're talking about, because you can't discuss the market rally without, of course, talking about AI. The technology has been around for decades, but has become a focus of investor fervor in recent months, thanks in part to poster child ChatGPT. And the comparisons with the dot-com boom are clear, but John Authors was at the Financial Times during that period and was across it all. He says it's difficult not to look at AI through that lens. Let's get back to John now, Bloomberg opinion columnist. So, John, bringing this back here, where do the differences between the dot-com boom and this AI fervor, where do they end?
Well, I know where the dot-com boom ends. I don't yet know where the AI boom ended. The similarity is fairly straightforward, that you have a very exciting breakthrough technology that everyone can see will probably have profound effects on people's lives, and that will plainly make a lot of money for someone. But those earnings, that money is most likely to be way into the future or a long way into the future, and it's very hard to gauge. So anybody who told you back in 95 when Netscape IPO'd that the internet was going to be a great thing were right. Netscape, as it turns out, is a name that has dropped and it's become a historical footnote, even though it was at one point the absolutely hegemonic web browser. And sorry, interruption from my kids in the background.
That's all right.
So the
So John, if what you're saying applies, and it probably does, right? The idea being that while we can all recognize that this is a powerful technology that potentially will change a lot, it is difficult to know who will win and who will not win, who might not even be around, right? And so,
well, I mean, in the case of the dot-com bubble, Google had not even gone public by the time the dot-com bubble burst. Facebook didn't even exist. A number of first movers didn't get to assert their dominance for the longer term. So, for example, Alta Vista was the dominant search engine for several years. I had it as my homepage for about 3 years. It's disappeared. Even MySpace was the dominant social media player before Facebook came in. So you don't know who is going to win, and the quote unquote rational thing to do is therefore to buy lots and lots of stocks of names that might benefit, and then if you're lucky, you find one of the names that really is going to win long term, like Amazon. But you're resigned to pumping a lot of capital into a lot of places that aren't going to make it. Now, we haven't yet, in the case of AI, seen what we saw in .com, which was large numbers of small companies with very little going for them. Some cases not even having revenues yet, going public and attracting money. Nothing remotely like that has happened. But when I look at NVIDIA, amazing story, making very real money. The comparison with Cisco is quite real. Cisco, like NVIDIA, the idea is we've got this great new technology. This is a company that builds the infrastructure for that technology. It's still trading Cisco now less than it was at the top of the .com bubble. That is what concerns me. Its valuation was, 200 times earnings. NVIDIA isn't far off that now. That is concerning.
John, stay with us. We are going to come back to you in a little bit, but we got to switch gears here and talk about this morning brief here. GameStop's leadership shakeup saw Ryan Cohen promoted to executive chairman. The Chewy co-founder, joined the company's board 2 years ago, and his cryptic social media presence became a beacon for the Reddit-fueled meme stock craze. Now he's in charge, and Yahoo Finance executive editor Brian Sazi has thoughts. Brian.
Yeah, I'm continuing my rolling heart attack from yesterday after that analysis of GameStop. So right on the Yahoo Finance homepage right now, I encourage everyone to read it. It is an open letter to Executive Chairman Ryan Cohen. I really felt, guys, this was the time to pull the trigger on something like this. We do not do this normally, but I think it was time. We continue to not hear from Ryan Cohen. No earnings calls, executives leaving out the door. And as you can see there, he has really significant involvement in GameStop. Of course, controls the board, 12% of the company right there. There's a timeline of his involvement. The stock has been really cratered over the past year and a half. Yet, as I'm learning here on Twitter again this morning, this guy continues to have major support among shareholders that might be losing large sums of money. And I just think it is time we hear from Ryan in some forum. Maybe it's live on Yahoo Finance. Maybe it's another forum. Maybe it's a Twitter Spaces with Elon Musk. Whatever it is, I think investors in GameStop that have been hanging on to this really dog of a company for the past year and a half hear from Ryan on what his plan is. And if he doesn't have a plan, That's fine too. Maybe just get out of the stock and go and get involved and start another company. But the bottom line is this, and I get into this in the morning brief, I think a lot of these supporters deserve respect. I think Ryan is disrespecting all of these shareholders, and they deserve better than what Ryan Cohen is giving him.
Why do you, how, besides the hate mail that you get,
yes,
which is purely anecdotal, what draws you to the conclusion that he still has investor support? I would suggest, looking at the stock yesterday, he doesn't have that
and you
support.
You brought that up, and that was a great point. And I'm just anecdotally, you go into the Reddit chat rooms, I see the vitriol, I guess, coming towards me on Twitter, which I'm cool with it. That's thick skin for me. Bring it on. I'm very encouraged to hear, or just very excited to hear why you continue to support someone that clearly doesn't have your best interest at heart. But when I dig down to the financials of GameStop, I'm a former analyst for about 12 years. When I dig into the analysts, the finances of this company, the annual reports, the 10Qs, the 8K reports, and it's a company that has structural issues. Sales are falling. Big losses the past 2 years, almost $700 million in net losses from 2022 and 2021, $50.5 million loss in the most recent quarter, no long-term prospects. This is a business really perhaps headed down the drain over the next decade, very much like a Blockbuster, like a Circuit City, like a Linens and Things, even like a Bed Bath & Beyond, which Cohen was involved in. And newsflash, he did nothing there as well. No improvement there. A Bed Bath & Beyond right now is going through a bankruptcy process. They're not going to exist in a couple months. So I think Ryan Cohen is failing here. The numbers would suggest that. The turnstile that has been the executive suite, that would suggest he's failing as well. He failed at Bed Bath & Beyond to drive any real change, and then he tried to drive change at Nordstrom, and he failed there because the Nordstrom management team is probably some of the best operators in the game. The stock price might not reflect that, but they're a lot better than Ryan Cohen.
So then what are the options here? I mean, we think of where the meme stock craze started in COVID, a lot of these Redditors getting together, trying to save some of these companies that they love. But what does the path forward then look like here for GameStop?
Management, careful management, Rochelle, whether that is a orchestrated wind-down process or some form of rolling liquidation over the next 15 years, it is very easy to see, at least in my humble view, where this is all going. You have increasing digital downloads of games. Ryan Cohen has still not given people, the average consumer out there that may go to Target on the weekend to buy groceries, any form of reason to go into a GameStop. This is a company that still operates over 4,000 stores and has millions of dollars of operating lease obligations on the balance sheet. And I think in order for a GameStop to truly evolve, maybe they just need to start selling fruits and vegetables, guys. And eggs.
Eggs, yeah.
Eggs.
Is that what? Okay,
Yes.
We'll see if
Maybe Ryan will do that. But I encourage Ryan to come on Yahoo Finance and stop hiding behind the shadows. And let's hear your plan, man.
Yeah, go in for a game, pick up some carrots. I like it. The GameStop story thank you so much, Saz. The GameStop story had its idiosyncrasies, but if meme media taught us anything, it was the perils of high valuations. Stocks plunged around this time last year, and some will remember it as the massacre of the memes. Writing at the time, our guest John Author said it was primarily driven by valuation and reminiscent of the bursting of the dot-com bubble, which we've talked about with regard the parallels between that and AI as well. Let's get back to John now. John Author is a Bloomberg opinion columnist. Yes. And John, it seems long ago now, actually, that these meme stocks were popping in such a way. I've heard a lot of people call the most recent melt up in the market a FOMO trade, right? And I just wonder how you're thinking about that period of retail enthusiasm followed by bust, and what lessons we can draw for right now.
Okay, I think they are quite interestingly different. Certainly there's something to do with FOMO going on at the moment. You really don't want to miss out on AI now that people are getting excited and people are diving in. What was different about the original meme boom, and I also know what it's like to get a lot of hate mail on Twitter and elsewhere, was that it wasn't just about, it's normally about greed and fear, but the GameStop rally back 2.5 years ago was about anger. People were angry. They were angry with the shorts. They thought they could get their own back and reform Wall Street by forcing people who had overdone the shorting of GameStop. And that was what was motivating people rather than the greed to get rich. It was sheer, unadulterated anger, which is a very dangerous phenomenon. That's not the normal market psychology. It's difficult to know how angry people will eventually come to their senses. You've got precedents for how greedy or fearful people do. So that's my greatest concern. I mean, I think the other point to make about the GameStop rally, which I don't think is present this time, is that that was at a much earlier stage of the pandemic, the cycle working our way through the pandemic. People had stimulus checks. There was this retail phenomenon that far more small investors did actually have some spare cash to do something interesting with. So I do think what we're seeing now is more meaningful and more in line with what you would expect from history than the meme stock boom of 2 years ago, which was just bizarre. Our friend Spencer Jacob, now of the Wall Street Journal, wrote a book called The Revolution That Wasn't, about GameStop. And I think in some ways that was right. It was almost an attempted revolution or insurrection that went on there, rather than anything more dramatic than that.
Does that to you signal a temporary, not sidelining, but perhaps kind of checking out of the game for some of the retail investors that at that time they had, to your point, stimulus checks, they had more time, they were at home in front of their computers at all times, and just also had some of that free time to just look at where they would potentially want to invest. And so now if you kind of flip that on its head, people going back into social constructs or going back into the office and whatnot, does that take time away critically for the type of volume that we had come to expect from some of the retail trading frenzy?
Yes, I think it does. I mean, we're still in unusual conditions. But it's mainly because of the bad air quality in New York today that I'm sitting at home. But it's still far more of us are spending more time at home than we did pre-pandemic. But yes, I don't know how far we've got in the pig of the pandemic working its way through the python. But we are certainly further ahead in digesting that shock. You've also seen with Robin Hood, which was causing great excitement 2 years ago and is causing somewhat less now. I think the extremes of that small retail boom are over. I do think the current rally is, this is a rally about very big companies that really do make a lot of money. Not about a pretty small company that really looks as though it ought to go bankrupt, which is what GameStop was 2 years ago. So this is definitely a more normal, more rational market, less led by angry young men in front of their computers.
Indeed. An interesting take there on that market psychology and how it's been changing. A big thank you there, John Authers, Bloomberg opinion columnist, for joining us this morning.
Thank you.
All right, coming up, Tesla calling the shots. Ford and GM join the EV leaders' charging standard. It's a big win for Elon Musk, but is it one for consumers? How much can a GM owner expect to pay at the supercharger? All that just ahead.
9:30 a.m. Eastern Time. That means the opening bell has officially rung on Wall Street. So let's take a quick look at the major averages here in the U.S. The Dow Jones Industrial Average that opens up higher on this Friday. It's up right now by about 0.5%. Well, we're going to continue to watch this, actually. Things are now calibrating. And so we're actually down by about 0.1% out of the gate here. Now that I've got the NASDAQ composite intraday calibrated here, you're seeing that higher by about 0.5%. And then the S&P 500, you're seeing that higher by about 0.25% out of the gate this morning. We'll give you a look at what's taken place over the past 5 days here. Past 5 days still net higher on a fractional basis by about 0.5% for the S&P 500. Let's take a look at some of those S&P 500 sectors here out of the gate this morning. Just taking a look at those 11 sectors, you've got a laggard in the form of staples right now. That's down by about 0.4%. Looks like a little bit more red than green. However, two of the outliers here, you've got consumer discretionary moving higher by about 1%, and additionally technology, that's up by 0.7% here on this Friday. Speaking of technology, let's take a look at some of the NASDAQ 100 components here on the day. Mega cap tech stocks on your far left side here. Taking a look at Apple right now, that's higher by about 0.7%. We've got some movement on Nvidia, Tesla. We'll talk about that in a hot second. That's higher by about 5.25%, 5.3% at the gate. Microsoft and Google, Alphabet, Alpha Google, whatever you're calling them home, call them up on this Friday here. And then just lastly here, I'll leave us on this EV board to kind of tee up our next conversation, Julie.
Yes, and I got you on that front. Tesla dominating in EV infrastructure. Another win as General Motors follows in the footsteps of rival Ford Motor in partnering with Tesla to use that automaker's charging network, gaining access to 12,000 chargers. Like Ford, General Motors will also begin installing a charging port used by Tesla, which is set to start in 2025. In the meantime, adapters are available for folks who have Ford or GM vehicles. Yahoo Finance's Akiko Fujita is joining us, and you closely track this sort of charging technology. I feel like you and I have been talking about this all morning, and there's still kind of more questions than answers about this. But why is it a win for Tesla? Is it a win for Tesla?
Well, I mean, bottom line, yesterday's announcement with GM essentially amounts to sort of this declaration that NACS, which is what Tesla uses, is now the standard in North America. And for those who don't drive an EV and aren't familiar, there's two standards. There's NACS, which was set out by Tesla, and Tesla's the only one that uses it. And there's something called CCS, which is the industry standard. So we're talking about Volkswagen, Rivian, Polestar, they all use that. Like Tesla yesterday, by making that announcement, we're talking about GM and Ford, the two largest North American car makers, that essentially says that Tesla gets to lead the way. Why is that? Well, bottom line, Tesla has the best infrastructure in place. And in order for drivers to get on board with EVs, you need to feel comfortable that you've got a charger ready to go wherever you are.
But do GM and Ford have to pay Tesla for that technology or the patent or whatever to make their ports compatible?
Well, so that's a big question mark, I think, and I'm not sure I have the answer to that specifically. But what's interesting to me is to look at the stock moves today of the other chargers, right? You're looking at ChargePoint, you're looking at EVgo, they're down. Now, if you don't drive an EV, you're not as familiar, but the reality is I have a Tesla, I charge at ChargePoint all the time. Tesla cars come with an adapter that allows you to charge anywhere. Equally, ChargePoint and EVgo have been trying to adapt as well to whichever the standard becomes. And it's interesting because I was looking back to these comments we got from ChargePoint CEO Pasquale Romano, who was on the afternoon show earlier this week. We asked him about the initial Ford-Tesla partnership, and he said specifically, we don't want our customers to have to assign a particular port. So he had already kind of hinted that they're looking at being able to be more accessible for Tesla chargers, so you don't have to use the adapter every time. I will tell you, it's not a big deal. You just pop on the adapter when you go to a charge point if you are a Tesla driver. Similarly, that'll happen with the other chargers too. So yes, Tesla has the infrastructure in place, and that is a big win. But these other companies, EVgo, ChargePoint, other chargers, have already been adapting to the potential of NACS becoming the standard, at least in North America.
For the other automakers that we're looking at on the screen here, General Motors and Ford, I think some of these announcements too are an admission swaddled in cost savings, if you will, to say if you're GM that, we're going to save $400 million by this type of partnership. It's also the admission at the same time that you need Tesla. You need that network that they've been able to build out. before there is a much more concerted type of infrastructural investment towards that network that has been starting to come forward but hasn't hit critical mass at this point.
But equally, Tesla needs them too, right? Because Tesla is opening up that technology. The reality is, if you want to get to some of these key goals that we've been talking about, 50% of new cars being all EVs by 2030. I mean, we've got these very lofty goals in place. If you're a driver, if you don't see the infrastructure in place, you're not going to go in that direction. Bottom line, to your point, Tesla is the one that has the infrastructure. If you are GM, if you are Ford, you're trying to really accelerate the process of adoption, you've got to go with what's in place.
I guess if you're a user, you don't really care which technology it is. You just want to have a place to charge your car. This whole story is making me realize how little I know about charging. So if you have a Tesla or if you have a Ford Lightning, say, does it cost the same to charge? Are you paying for the electricity? Just like if I put gas in my car, I'm paying the same for gas no matter what kind of car I have, unless I'm getting premium, et cetera. But leaving that aside for a moment, are you just paying for the electricity?
So you're talking about as a driver?
Yeah.
Well, it depends, right? So charge point chargers, it's important to know that the way they work is they don't actually sort of pay for the charging themselves. Essentially, if you are a Target, you purchase the charge point charger, and then charge point offers the service to be able to charge. And it depends on where you are. For example, I charge up at our office in California. It doesn't cost me anything. I just put it in because whoever is owning that allows for that service to be had. The Tesla supercharger, a full charge, anywhere from $18 to maybe $25. I mean, it's
that's
not
what it would cost you, not as a Tesla owner. If you were
as a Tesla owner,
as a Tesla
owner, because the supercharger you can get a full charge in about 30 minutes or so. So it's much quicker.
And if I'm a GM or Ford owner and I go to a Tesla charger now with my adapter, is it going to cost me more because I have a Tesla or a Ford? I mean, a GM or a Ford?
No,
than
it's
it
the
would
same cost.
Okay,
it's the same cost. But you can get free chargers. Well, you can charge for free.
Yeah.
At a charge point location, depending on where it is, of course, because it's up to that business how they want to structure it. But it's going to take a lot longer. A full charge is 6 hours?
Okay.
Versus 30 minutes at a Tesla supercharger.
Oh, wow.
Which one are you going to choose?
30. Easy.
It's
Michelle?
pretty quick. By the way, I should point out, if you go to a Tesla supercharger, there are long lines right now. And that's just with Tesla owners. So what is that going to look like now that GM and Ford can also get on board? I am curious about that.
Yeah, that's a good question.
Huge story here on the day.
I mean, and I'll be curious to see what...
Oh, yeah.
I was going to say, I'll be curious to how the other automakers who aren't a Ford or a GM are reacting to this now that, the gauntlet has been dropped here. So interesting stuff there, Akiko. I'm a little bit more open to it. If I knew I had more access to a supercharger closer to me, depending on whether I got a Ford and I didn't feel that I was locked into necessarily getting a Tesla, I'd be definitely more open to getting one. Yeah, we're going to shift gears now and talk about the bulls getting even more bullish on Netflix. The fresh enthusiasm today coming from a Pivotal Research Group analyst who upped his price target on Netflix shares to $535 from $425 Friday, cheering the password sharing clampdown, among other drivers. Now, his $535 target is the highest on the street, so definitely worth keeping that in mind. Brad?
Let's add on to this a little bit more, too, because we've got the pivotal note this morning.
The pivotal note, but there's also new data out from this company called Antenna that monitors subscriber growth here. And since subscribers found out that Netflix was going to start cracking down on password sharing, according to Antenna, Netflix has had the 4 single largest days of U.S. user acquisition in the 4.5 years that Antenna has been tracking this. Yeah. So really interesting. So what Antenna is now saying is that Netflix saw almost 100,000 signups per day on May 26th and May 27th. So this really gives credence to what analysts like the folks at Pivotal have been saying, that this is going to be a boon to Netflix. And we've seen Netflix shares bounce on all of this. Yeah, Pivotal upping their target to a street high of $535 per share and saying in the bottom line they raised it because, to a lesser extent, the effects of increases in their free cash flow expectations in 2023 and beyond, but ultimately saying that Netflix represents a unique tech growth story, given it remains well-positioned to generate solid subscriber and revenue/free cash flow growth, even in a potential global recessionary environment, via their better monetization of the approximately 100 million plus households that currently utilize Netflix outside
of paying households via password sharing.
You know, there's one more thing that they said in that pivotal note that stood out to me, Brad, although I guess it's a reiteration of something they've already said, which is that Microsoft eventually is going to step in and buy Netflix. That's what the pivotal analyst said. They said, recall our view that after a strong year in 2023 and 2024, management may look to sell the company in 2025, with Microsoft being the most logical acquirer in our view.
Yeah. Well, potentially. We will see. We will see if MSFT takes the bait there. Also, we're tracking shares of DocuSign this morning. Ticker symbol DOCU moving higher by about 3% on the day. Shares getting a boost this morning. The company coming out with strong guidance, beat estimates on both the top and bottom line. In the latest quarter, DocuSign also announced a handful of new C-suite hires, including a new CFO, Blake Grayson, who formerly served as the CFO of the trade desk and in other finance roles at Amazon as well here. So some significant moves there in terms of some of the numbers that the company had put forward in this most recent quarter as well. Total revenue increased by about 12% year over year. Subscription revenue specifically, that increased by about 12% year over year as well, while professional services, that was up 14%, and billings also hit $674.8 million. That's an increase of 10% year over year from this point.
Yeah, analysts, when it comes to these DocuSign numbers, don't seem that unreservedly optimistic, right? Some of them are talking about that the outlook is still a little, even though the company's numbers technically for forecast came in above estimates, there still seems to be some questions about whether they will actually get there. So it seems as though the optimism that we're seeing today is tinged with a little caution on the part of analysts.
Yeah.
No, I would agree, because obviously DocuSign was one of those pandemic darlings that a lot of people flocked to when they didn't have the option of coming into the office. So it'll be curious to see where that next growth story is going to come from now that you do have a lot more people returning to the office. So optimism there. I'm not sure I 100% buy the optimism that they have, but an interesting growth story here so far from DocuSign.
Yes, we will see. All right, the U.S. could be on the cusp of a big construction boom. Companies are taking notice of the wave of investment rising across key markets, infrastructure, commercial, and residential end markets. Catherine Thompson, partner at Thompson Research Group, has a list of stocks that stand to benefit. But let's start with the big picture here, Catherine. The construction golden era that you are calling for. So what sort of sets the scene for that construction golden era?
Yeah, so there's the four key trends that we see and identify that are driving what we call a construction golden era. The first is reshoring or nearshoring. This is a product not only of the supply chain snafus from COVID, but also the trade wars and the pendulum swinging too much. So you're having companies that are rethinking and bringing production some of it close to the U.S. The second is just a population shift, just a structural population shift in the U.S. It is driven by the Great Recession, trade wars, and also COVID. So you're having both a financial and social event that is driving. You were already having companies moving headquarters to that region post the Great Recession, but it went into overdrive post-COVID. The third one is just government support for key spending. IIJA is a significant infrastructure funding mechanism. You have the CHIPS Act and the Inflation Reduction Act. All of those hit various factors. And then finally, you have just increased spending and focus on environmental matters. A lot of this that is coming to the US. You know, any one of these could be significant for the construction industry, but all four combined essentially sets us up for significant visibility, not just over the 1 to 2 years, but 5, maybe even 10 years.
Catherine, when we think about this golden era for construction, what stocks are set to benefit the most?
Yeah, so there's, I'd say there's two buckets, and I'm going to focus on one of them that's in that bucket. Heavy materials companies, so it'd be like Vulcan and Martin, which are just, it's basically rocks, cement, concrete, and asphalt. Those, you have to use all of those construction. The one I'd like to highlight is a company called CRH, and we think that is just a sleeping giant. It's a company that is headquartered in Ireland. We picked up coverage of it early this week, and just yesterday, it was an overwhelming to move it from the London Stock Exchange to the New York Stock Exchange. This is following the same trend as another European company in the construction space, Ferguson, who did the same thing last year. What most people don't realize is funny. I was in New York and Boston this week talking to investors, and it's so surprising that people don't recognize a 30 billion market cap company in the construction space. They own the largest reserves for aggregates in the US, which carries a very high multiple. And ultimately, CRH stands to benefit. So not only from the construction boom, but also the multiple expansion, just simply by moving from the LSE to the NYSE. They also have a outdoor living, so that'd be a comp to like Trex and AZEK. But overall, with CRH, we just have a really interesting structure. And like you've had this sleeping giant that stands to benefit with 75% of their EBITDA in the U.S. To benefit from this construction boom.
Interesting.
Another category to think about are equipment rental names too. So it would be like Herc, HRI, and URI.
Catherine Thompson, Thompson Research Group partner. Thank you so much for joining us this morning. We appreciate the time and the breakdown here. We got to check back in the future. Also, everyone switching gears, market meltup, that continues. Even with Treasury yields on the rise. Find out why our next guest calls this year's gains unprecedented. That's next. Behold, we have officially crossed over into bull market territory, but a closer look may reveal bullish signals lurking under the dazzling tech-led market rally. For more, we're joined by Jared Blickery from the New York Stock Exchange. Hey, Jared.
Hey there. Well, this is a tricky market, isn't it? And let's take a look at the Wi-Fi Interactive. We have S&P 500 climbing into what some people call bull market territory. Notice I don't not necessarily glom onto that definition. I don't think it's particularly useful in how I see the market, but nevertheless, it generates a lot of headlines, and so people take notice, so it is worth keeping track of. But at this point, with this another break up here, I'd say the price action this year, we're seeing a lot more trends than we were last year, and they're evolving a little bit slower. So the temptation to jump into the market at these higher levels is still quite there. A lot of fund managers, as I've been talking about, if they're flat right now, they're flat-footed, they might as well be short. They're kind of forced, they're being sucked into the market right now. So all things point to potentially higher prices in the indices, but nevertheless, there are some divergences that have evolved with respect to equities, that is stocks, and the credit markets and treasury rates, that is the sovereign rates. Here's the Russell 2000, you can see this breakout here, a lot farther to go than, say, the NASDAQ would. But let me get to the volatility markets, because one thing I've been keeping a very close eye on is the VIX, and that has been coming down quite sharply for equities. And there's an interesting phenomenon going on. I've heard different explanations for this, but let's also keep in mind that the market, in large part, a lot of these gains have been fueled by options expiration, the weekly ones like we see on days like today. That's also affected the market. Looks like my Wi-Fi Interactive is stuck here, but anyway, if you're looking at the VIX, it's basically, there we go, it's at multi-year lows. It's back in the range we saw prior to the pandemic. This is sending all kinds of signals, bullish signals to systematic traders who follow rules, and it's just sucking them into the market even more. You compare that with the ICE B of A Move Index. I'd say one similarity is that they're both going down, but the B of A Move Index not going down by quite as much. And this is a 5-year chart. I think it'll be more instructive to look at a 1-year chart. So we are relatively elevated in the treasury market, in the bond market versus equities. And I think that's kind of showing a divergence as well. The real test is going to be next week when we get that CPI report and what the reaction is to it in the markets. Is a lower CPI, is good news going to be good news for the market? Is a higher one going to be bad news for the market? Going to be really interesting to see. So it looks like there we go. ICE B of A movement index definitely looking higher here. I think we want to talk about the dollar, so I'll save a little bit of time for that, guys.
Yeah, let's do that, Jared. Talk to me about the dollar.
All right. Well, the dollar has been a thorn in the side of equities and a number of other markets. I'm going to see if I can get it up here, but it looks like I got a little bit of delay. Anyway, the dollar has been at times very strong, but it came off that strength and it gave the markets a respite this year. I think in large part that fueled, or helped fuel, I should say, a lot of the gains that we saw earlier in the year. Now, in general, when we're talking about mega caps, these are the stocks that have benefited disproportionately from the lower dollar, from lower rates. When we talk about that, if we did a reversal to the upside in the dollar, that's going to hurt these guys, right? And that's what we've seen historically. So we got to keep in mind that could come about, but also looking at the various currency crosses. One thing in particular I'm looking at is US dollar versus the yen. The yen has been incredibly weak. I'm just going to add a couple comments here. The Bank of Japan may be finally forced to relinquish control over the yield curve. That would mean YCC is out the window, and that would probably lead to a very large strengthening campaign on the part of the yen. That usually happens late in the business cycle, and so that's kind of a bellwether for equities too, if we see a huge strengthening in the yen, but we haven't seen that yet. And then there's the Chinese government, which is trying to stimulate the economy in very narrow conduits, but if that doesn't work, they're probably just going to do a blanket devaluation like they've done in years past. So all of this fitting together, lots of dynamics.
Indeed. Thanks so much, Jared. Appreciate it. Well, the market melt-up turns on. Even a sharp rise in Treasury yield isn't derailing it yet. The S&P 500, now in a bull market, has returned around 12% year to date. The tech-heavy NASDAQ jumping more than 30% in that period. Our next guest says that concentration of stock market gains has reached a truly unprecedented level. Joining us is Dana Diaria, who's Investnet co-CIO. Dana, thanks for being here. So there has been a lot of discussion about the consternation over this narrow leadership, but it hasn't mattered yet. What's going to make it a problem, or what will be the catalyst for it becoming more of a problem?
You know, sometimes I feel like I've been talking about this for a while, and you're absolutely right. It's like, well, the market doesn't care. You know? we plow on. I'll tell you one, and I mean, you know, this is can't predict, but obviously there's some concern around some of what I think is driving this, which is, of course, artificial intelligence and, you know, kind of money being plowed into that. And we've seen, interestingly, these AI CEOs come out and talk about the fact that they think the government should be regulating this more. So I think, you know, that maybe not just AI, but regulation in general, you know, finally coming to bear on some of this and taking some of the sheen off. I also think, you know, if you're expecting a pivot on interest rates from the Fed, there's some evidence to suggest that's not necessarily going to happen in the second half of the year. We've had a couple central banks actually raise rates, Australia and Canada, 25 basis points, somewhat unexpected. And so, you know, the Fed, along with a lot of these central banks, is a bit more concerned still about sticky inflation than they are, you know, about the fact that we may be headed for a recession. So those are a couple things, right? Because obviously rising interest rates, not great for growth stocks.
So let's break some of that down, because you mentioned the Fed there. How are you positioned for a pause and a pivot versus a pause and a skip with a potential hike coming up later in the year?
Yeah, look, I mean, I think to the extent that the odds are priced in, right, for what that's going to be, and we're kind of incremental here, right? This is not what happened last year, where you have abrupt and very steep increases in rates. We're talking now, we're in the realm of 25 basis points here and there. I think actually, you know, when you think about just the fact that this monetary policy acts with a lag, probably what you should be thinking about is, you know, the junction of that with the fact that the Treasury general account does have to be reloaded, and that's going to happen now that the debt ceiling debacle has, you know, we've gotten past that. So there's reason to think that liquidity will be sucked out of the market, that the monetary policy interest rate increases that we've already seen are going to hit the economy with a lag. I think, you know, even if we did get a pivot, which is not really my base case, I'm not sure that it counteracts these other you know, what we're going to see in the economy related to these other effects.
What is your base case then?
You know, I would say that we probably get a pause in June. I think that's the consensus. And I think we probably stay steady for a while, you know, just based on what we see now. I'm not anticipating that we should expect a pivot from the Fed, in spite of the fact that I think there's evidence that we do potentially enter a recession in the second half of the year. I'm starting actually to see economists come out and say, of course, that maybe we're in recession already. Of course, I know, notwithstanding that we just got out of the bear market, right? So definitely a bifurcation in what the market sees. And, you know, the average investor, right, they're in the index. So for them, they're not really seeing what's going on beneath the surface that we're all talking about, which is that, you know, what's driving all of those gains that they're seeing is, in fact, these 7, call it maybe 8, you know, if you want to throw Netflix in, stocks.
Yeah, so that's exactly what I was going to ask you. Is there a way to play, even if we do see a pause from the Fed for near term, is there a way to play that in your portfolio? Is there a playbook that investors can look to right now?
Yeah, well, so if you think pause, of course, you're not as worried about what happens to growth stocks, but that's just one input. I mean, generally speaking, I would say, look, if you're an investor and you're in the market cap weighted index, you're stuck with a heavy loading of these stocks, whether you kind of like it or not. But to the extent that you want to hedge a little bit, tilting towards a value, you know, so in other words, if you think about an economy where some of the liquidity is getting sucked out, that should favor value stocks. You know, tilting, just kind of moving a little bit away from the index toward something that, you know, accounts for the fact that value stocks, for example, that pay attention to price, that accounts for the fact that, you know, maybe these stocks will struggle a little bit going forward if we do move into recession and if the Fed doesn't pivot.
Okay, we'll see what ends up happening. Dana Diaria, Envestnet co-CIO. Thanks. Have a great weekend.
You too.
Coming up, the Eurozone slipping into a recession, but U.S. consumers are still keeping the world's biggest economy out of one. Could that all change in the next few months? We'll talk about it next. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Rochelle Akufo. We're a little more than 30 minutes into trading. So let's take a look at what has been moving since the open. Tesla is one of the biggest movers today, trading higher after GM announced Thursday it is joining forces with the EV leader to leverage its supercharger network. The announcement coming 2 weeks after Ford announced a similar partnership to enable access for Ford vehicles to Tesla's charging network. Tesla shares up for the 11th straight session, Brad.
We're also watching shares of NIO, the Chinese electric vehicle maker, reporting mixed first quarter results. Revenue came in lower than analysts' expectation, but June's delivery figures, a little bit of a silver lining there. The company expects to deliver 10,000 to 12,000 vehicles in June. That's significantly higher than May.
And Corning, the glass and ceramics and fiber manufacturer, jumping this morning after Morgan Stanley upgraded the stock from equal weight to overweight, raising its price target from $35 to $38. And the analysts there saying there is scope for positive earnings revision over the coming year. That is behind that upgrade. The S&P 500 now in what Wall Street refers to as a bull market. The index up 20% from its October low. The recent rally in equities has Wall Street hopeful as more economists are becoming increasingly less worried about a recession this year. Yahoo Finance's Josh Schaefer has the details for us. Josh?
Yeah, Julie, so it's the second week of June. We spent a large part of the beginning of the year talking about that 2023 recession, right? When will it come? It might come in the second half of the year. It might come early in the second half of the year, which in theory would be soon. But now as that date is sort of approaching, we're seeing economists cut back on that. If you take a look at GDP and what's happened there, I think that was a large part of this, at least a few months ago. And you take a look at first quarter GDP actually getting revised upward to 1.3%. Wells Fargo coming out this week now saying they expect a recession to actually come in 2024. Of course, we talk about GDP because that is one of the key metrics that we watch when we talk about recessions. We could get into a nuanced debate about if we were in one in 2022 when we had 2 consecutive quarters of negative GDP, but we'll save that for another day. And I want to take a look at non-farm payrolls because that's something that a lot of economists are watching right now, because you take a look at what we saw in May, that big jump up, 339,000 ads. That was the largest monthly ad since January. So right now you are seeing a very strong labor market, and until that comes down, economists simply don't see a recession happening, and it's going to take some time for that number to come down, right? So we're talking probably not Q3, maybe Q4, and again, to really be in a recession, we need repeated quarters of slowing economic growth, right? So that's why these projections are starting to get moved out into 2024. And the final thing, Rochelle, I want to take a look at here is just simply the S&P 500. We talk a lot about how stocks and markets predict what is going to happen, right? Not what has happened. Well, if we take a look at the S&P 500, as we mentioned off the top, entering bull market territory yesterday, if stocks are a forward-looking indicator, people feel pretty good in general about the economy right now, and at least aren't seeing that slowdown quite yet, Rochelle.
Indeed. I mean, especially as we look at the VIX at the moment, significantly down over the past year. Great stuff. Thank you so much, Josh Schaefer, there for us. Taking a look at the state of the consumer, it's been a mixed picture to say the least. Well into the spring season, we've heard from retailers like Macy's and Home Depot saying that consumer spend trends have weakened this quarter. But despite challenges from higher inflation, households continue to spend at a healthy pace in May. Bank of America released findings from its latest consumer checkpoint report, which showed credit and debit card spending stabilized last month. For more, we're joined by David Tinsley, Bank of America Institute senior economist. Thank you so much for joining us, David. So looking at the title of this note here, The Young and the Restless. So we're talking some generational differences here. Talk about what stood out to you from this latest data.
Yeah, well, as you say, broadly speaking, the overall picture is stable. But really, this title comes from the fact that younger generation spending is a lot weaker than older generation spending. It's sort of 4% difference year on year. When I say younger, I'm saying Gen X downwards. So anyone below 50, really. And then really the older upwards of that. So that's really the striking thing. And the restless in this title, this comes from the movers. One of the reasons for this difference is because when you look at the data, younger people move house about twice as much, twice as frequently as the older generations. And every time they move, they face higher rent, higher mortgage rates, and quite possibly higher house prices. So they have, in a sense, a fiercer gale blowing in their faces from housing costs.
And so, David, I don't know if you just heard what Josh was talking about, that there seems to be sort of a shift in the most dire recession predictions coming from some of your economist colleagues across the street. How does what you're seeing in the consumer picture feed into whether we're going to be getting a recession and when?
Well, that's an interesting point. I mean, the consumer isn't in recession. They're doing quite well, thank you very much. Since the start of the year, this month was, flattish, but by and large, they also benefited from a little bit of a headwind from lower gas prices. But I think, and this is where I'm not a forecaster in my role, so I won't seek to project when the recession will occur or if it will. But I think a lot of forecasters have always said the recession would probably come outside the consumer in any case. So for construction, business investment, trade maybe, those kind of things. So the consumer is strong. I don't think that necessarily means the US can't go into a recession.
So if the consumer is strong, does that necessarily correlate to companies still having pricing power, or has pricing power receded?
That's a good question. So I think, going back to my earlier point, this generational split has a role there. So in aggregate, the picture's decent. If you're selling into markets aiming at the older generations, you're probably doing better than average and you've got pricing power. If you're aiming more at the younger gens, maybe not so much. I suspect this generational spend story translates across into different kind of perspectives from business on how they are faring overall.
And David, what are you seeing in terms of what different generations are prioritizing in terms of their consumer spend?
Well, what's happening essentially is it's still really this story of an unwind of goods spending into services. And we're seeing that really across all generations. But I think particularly amongst the older generations, travel, international travel, is doing very well. Cruises as well. I think in a sense, as we go up the generations, the travel is really standing out.
David, I don't know if this is research you guys have done, but I've been looking at your note from today about the generational differences. Is the gap that we're seeing typical on a historical basis? And do Gen Z and millennials have the potential future earnings power enough that they will eventually get to the current spending level of the older cohorts now?
Yeah, right. So, I think typically you wouldn't expect the size gap to persist for that long. When you look at the accumulation of wealth, it's very unequal, really, across the generations. Older generations have 8 times the amount of net wealth than the younger generations. And there's always going to be some of that, because obviously people accumulate that over their lives. But quite a part of that is also just house prices. And the fact that this tight supply in housing, which has persisted for a long period of time, has forced up prices. And that's benefited people who own and disadvantaged people who don't own. And so I think, there is this kind of built-in, if you like, headwind blowing against the younger generations currently until that housing market, until particularly supply comes on in more significant amounts.
Yeah, that's quite interesting. So I guess we'll keep in touch and see if that starts to happen. David Tinsley, Bank of America Institute Senior Economist, thank you.
Thank you.
Coming up, BlackRock turned heads this week with a key acquisition in the private credit space. Is this the new normal for the industry? And let's talk about some of the internal politics as well. We'll get into that next. BlackRock boosting its private credit business this week, acquiring London debt specialist Kreos Capital, the new partnership unlocking new opportunities for client investment in the booming private credit space. Private credit increasingly a vogue. It's a process that sees money directly lent to companies, bypassing banks. Moody's projects the market will reach at least $2 trillion by 2027, more than doubling its value in just 7 years. Liz Hoffman's a business and finance editor at Semaphore. She joins us now. Hey, Liz, how you doing? It's good to see you.
Good morning. Thanks for having me.
Yeah, we're watching this sort of boom in the credit market. At the same time, over the past year, call it, there have been some questions raised about whether there are some risks inherent in the growth of this private credit market. What do sort of regular investors need to know about this space?
Yeah, this is, as you know, growing incredibly quickly, 1.4 trillion or so these days, doubling in the past 4 years with a lot of room to run, I think. But this entire industry basically cropped up since the last crisis in 2008, and so really has never been tested. Look, the people I talk to, these deals I think are underwritten more conservatively. There's less leverage, but it's also been spread throughout the system, right? If you're thinking about risk, you want to think about it two ways. Like, is the piece of paper problematic? And then how widespread is it? And I think these are probably safer loans, but they are tucked in lots of different places. And consumers may have exposure to them, particularly through vehicles like BDCs, business development companies, which have gone public at a clip in the last 10 years, raised a lot of permanent capital from retail.
And so as you look at the size of this market, are you seeing any sort of trends that we're seeing here, especially in the fallout from SVB and some of the traditional banking sectors?
Yeah, you noted the BlackRock deal, which I would say is actually adjacent a little bit to core private credit. It's mostly venture debt, probably going to pick up some market share from Silicon Valley Bank. And that's an asset class that I think has a lot of people are very excited about it, but it's going to take a minute to recover from the collapse of SVB. The interesting dynamic, I think, is, banks really sort of syndicated bank loans, or a bank underwrites this loan and distributes it to its clients, really kind of shut down at the end of last year and has not really reopened at a serious level, some green shoots here and there. But the question to me is when banks sort of get their arms around risk again, and remember, they're still kind of choking and digesting a bunch of LBO debt from the end of last year, Twitter and some other deals like that are weighing down their ability to play here. My question is how much of that market share shift is permanent, right? How much of it just goes back to the banks because they tend to be cheaper versus, is this a real toehold? Is this a really new asset class in private credit that can stick around?
What would you look to say that lending itself will outlast this next recession?
Well, there's two sides to lending, right? There's supply and demand, like everything else. But loan demand has been slowing, as the economy slows. Those are pretty good proxies for GDP, and that has been trending down. The sort of, it's been offset by a lower supply, which is banks kind of pulling back, and these private credit funds, which have been raised very quickly, taking a little time to get money out the door. So it hasn't really been, it's a little chicken and egg, right? We haven't seen a lot of leverage buyouts, so we haven't really had to test the availability of credit. And then on the flip side, we haven't really seen one of these private credit deals go belly up yet. I think there's a question about sort of how that'll be tested in a bankruptcy process. It's sort of a little more unwieldy in one way because it's spread all over the place, but also, I think more conservatively underwritten. So, look, one of these big club deals where these direct lenders have all written, let's say, $100 million check is going to go bust, and we'll see kind of how well the business model holds up.
Liz, the most recent story you wrote is sort of a classic Wall Street turmoil at management at a company, in this case, a company called Blue Owl, which resulted from the merger of two other companies. It's a publicly traded firm, but it seems like there's a little bit of tension there. Tell us about it and what the implications are for the company.
Yeah, Blue Owl is, I think, the poster child of this huge boom in private credit. It was formed just 2 years ago, merger of two kind of Wall Street superstar bands in their own right. Owl Rock, which was founded about 5 years ago by alums from Blackstone, KKR, Goldman Sachs, I mean, a real who's who, and had raised just tens of billions of dollars incredibly quickly, mostly to do this middle market lending to finance these buyouts. They merged with a firm called Dial, which had been spun out of Neuberger Berman, and their specialty is another hot area on the other side of the ledger, taking stakes in private equity firms themselves. So these are two really fast-growing, sort of edges of the private equity industry, which is just moving away from its roots in private equity. These firms are not buyout shops anymore. They are sophisticated alternative asset managers. And, this kind of Wall Street super band is breaking up. And so, as I reported yesterday, there's kind of battle lines being drawn along the lines of that merger. And the Dial founder, a guy named Michael Reese, is being pushed out and asked to resign by his partners from the Owl Rock side of the merger. And he has said, perhaps understandably, like, I'm not going anywhere. Like, I built this business. He built it starting in 2010 at Neuberger, and it's really his baby, and he doesn't want to leave it behind. So a lot of egos under one roof here, and I don't think we've heard the last.
7-4 business and finance editor Liz Hoffman. Liz, great to see you. Great to get some of the latest reporting. Appreciate it.
Thanks for having me.
Absolutely. Coming up, everyone, the climate impact from the latest string of wildfires in the Northeast. And we're breaking down news on General Motors, Tesla charging port deal with Roth Capital Partners senior research analyst Craig Irwin. Got all that coming up, much more. Air quality alerts continue to be triggered in the United States as smoke from the Canadian wildfires continue. And the issue is far more wide-ranging than just climate change, as it also impacts everyday life and our health. Yahoo Finance's Akiko Fujita sat down with White House National Climate Advisor Ali Zaidi to learn more.
The West is in conditions that are really unprecedented, and we're seeing that in Canada as well. We're seeing heat waves ravage the country. Puerto Rico seeing that right now, but that interacts in a very bad way with drought and a lack of precipitation. And these things combine to really fuel wildfires, which have become increasingly frequent and severe across the West and in parts of Canada over the last several decades. We know there is science that tells us that this warming, these drought and heat events, that the increasing spread of wildfires relate back to things that we are doing to the environment. Putting carbon pollution in the sky has consequences, and we are living those now.
In many ways, if this is kind of the new norm we're having to deal with, cities from New York to Philadelphia are learning the business disruptions that are likely to come along with it. We saw flights that were grounded yesterday, sporting events canceled as well. Can you talk to me about that kind of impact that we're likely to see if this is going to become more and more frequent?
Yeah, folks often talk about climate change as if it's an environmental issue and an environmental issue alone. It intersects with every aspect of our life. It is a public health issue. Folks see that right now as they put masks on. But it is also an economic issue that can cost in the trillions of dollars. We've seen climate change disrupt supply chains. We've seen climate change hike up the costs of consumer goods. And we know that the only way to resolve ourselves is to resolve ourselves to shift as quickly as we can to clean energy and to invest, as the President Biden has, in resilience and adaptation to the impacts of climate change that we've already unlocked. But you're absolutely right. This is a supply chain risk. It is a material business risk, and smart money is chasing solutions, not, putting its head in the sand.
Where do you see the role of the White House? I mean, so much of what we are seeing right now, to your point, is on a very localized level. We know officials in these major cities yesterday scrambling to make sure those that were living there were safe, but also that businesses were operating normally as well. What do you see as a role on the federal level?
So in dealing with the issues that we have right in front of us, the president has been briefed on this. We've deployed human capital and water bombers, other aerial assets to support the Canadians. We've activated our National Interagency Fire Center to support response on the fire side. We're also deploying our EPA. Folks can go to airnow.gov to get real-time data using the air monitoring system that we've helped build out under the Biden-Harris administration. Our CDC is activated to support state and local officials with whom we've also been in touch with here from the White House. So there is a response aspect of this that's playing out in real time. And the president and the vice president have been animating that with a sense of urgency. And then, of course, the big thing that we can do is tackle the climate crisis, which is why that has been a fundamental pillar, an element of this administration's leadership. We've invested the most in clean energy and climate anywhere in history ever under President Biden. That's the root cause, and we got to get after that.
You talk about this being more than just an environmental story. Obviously, there is a huge economic impact. We have seen that play out really on a personal level over in California, where most recently we heard two major insurance companies, Allstate as well as State Farm, essentially pulling out of new coverage. It's simply too expensive for these insurance companies to try and insure homeowners who are in very vulnerable areas. There is the argument, of course, about whether, in fact, they should continue to be building there as well. But from a homeowner perspective, this has got to get a lot more costly, and they can't find insurance as well. I mean, talk to me about how you're looking at that from the DC perspective and how the White House is working with local officials to try and mitigate this.
Well, number one, we know that there are ways to both boost the efficiency and resilience of homes. There are fire-wise building code standards. There are water smart building code standards. And one of the things we're working on with state and local officials all across the country, and this has been capitalized by the bipartisan infrastructure law, is an effort to boost the codes with which we build new homes. So we're putting less strain on the system, and we're de-risking these built environment assets. That's going to be an important thing that we do. The second is making sure we're funding the retrofits to existing building stock, whether it's on the private side, thanks to tax credits included in the Inflation Reduction Act, like the Section 179D tax credit, which helps boost an energy efficiency of commercial buildings, or it's the direct grants that we're making through the infrastructure law that build resilience into our communities. We've got to rehabilitate our existing infrastructure and assets to harden it to this new reality. And then we've got to make sure that the market is helping foment solutions as part of this as well. That's why, in May of his first year in office, the president signed an executive order on climate-related financial risk. In that, he directed his Treasury Department and regulators to take a look and start to do the analysis underpinning how we better understand the physical impacts of a changing climate on the financial markets and our ability to ensure and make sure that we're propelling the private sector to come up with solutions. There are solutions in the space. We've got insurers, for example, in Florida that for over a decade have been helping finance retrofits to adapt homes to hurricane risk. You get a premium discount if you make the investment to bolt and brace your roof. So there are innovative solutions in the space. We need the market to chase after that. We need the regulatory infrastructure to promote that. What we don't need is a bunch of folks pretending like the problem doesn't exist or denying its impact on our economy and our way of life.
Well, on Thursday, General Motors announced that they'll be partnering with Tesla to gain access to the 12,000 EV charging ports across North America. GM CEO Mary Barra stated that the new deal will save the company up to $400 in EV infrastructure. $400 million, thank you. And like Ford, General Motors will start installing Tesla's charging ports in their vehicles starting in 2025. Joining us is Roth Capital Partners Senior Research Analyst Craig Irwin. Craig, it's good to see you. We've been sort of trying to figure out what exactly this means. Among other things, are there financial implications for Tesla? Like, this is obviously being seen as a win for Tesla. I'm just trying to figure out why.
So Ford and General Motors, obviously it's good for both of them because their customers are not going to deal with the issue of range anxiety. Range anxiety is actually very real. I imagine, having to drive half an hour, 45 minutes to go to a fast charger. It's a pretty frustrating thing. And I've lived through that. For Tesla, there's a few different things in place. So one is, yes, I can't imagine them not wanting to make money on this. So are they going to charge Ford and General Motors the same price for their customers to access the supercharger network? Or are we going to see them paying premium? I would not be surprised if they were paying a typical premium versus the Tesla customers. And then you have to look at the impact on the Tesla brand. So nothing is going to irritate a Tesla owner more than lining up behind a bunch of vehicles from Ford and General Motors. I mean, imagine a big Hummer is going to take a charger for an hour in front of you while you've got to go and do your errands and get your groceries. It's not going to be something where people are going to say, "Oh, great, that car has General Motors badge on it," but the charger says Tesla. I paid for that. What's up with that? It's not going to be good for Tesla's brand, but it will be good for their access to subsidies under the infrastructure bill. So, lots of things in play here. People are speculating about what it means for earnings, but it's blatant speculation because we really don't know what the pricing is going to be at this point.
So then I was going to ask you about biggest winners and losers here. Obviously, the losers might be some of these other Tesla drivers, as you mentioned, stuck behind a line of Ford and GM drivers. But what about some of these other car brands? Does this perhaps force Honda and other brands to try and come to the table as well?
I think actually some of the biggest winners are going to be the other network operators, because it's going to give pricing visibility on the sale of electrons. So Electrify America is owned by Volkswagen. They have a fantastic fast charging network across North America, and then obviously EVgo has a really solid fast charging network as well. Of the roughly 26,000 DC fast chargers, half of them, more or less, just under half, are operated and owned by Tesla. So those other owners of the infrastructure, I think, get a little bit more price visibility and quite possibly more demand. Across the board, this is going to be good for EVs. It's going to make it more competitive. It's going to make it more realistic for drivers to be able to actually get out there and go from A to B, long distances, and not have to worry about charging. And, I think this is a great move for Tesla. It's a great move for both General Motors and Ford.
Craig, I want to dig a little bit more into what you mentioned about some of the other charging networks. Because if you look at EVgo today, if you look at ChargePoint today, if you look at Blink today, they're all down. So if you're right, it seems the market is sort of fundamentally misunderstanding what this means for overall for charging networks. Should people be buying those stocks today as we're seeing that dip?
So investors don't discern too terribly well between these companies. Actually, Tesla is very much a misunderstood company in my opinion too. So Blink, I think this is a positive because Blink does operate its own network, and Blink is OEMing charge equipment with credible suppliers. ChargePoint, I absolutely hated their stuff when I had to fast charge on a ChargePoint DC fast charger. It was a horrible experience. I did not like that. They do very, very well in level 2. That's where they make all their money. This puts more pressure on them to get it right. The network operators, I think, are going to get price visibility, and price visibility is a very important thing. Can you make money selling electrons? Tesla's obviously going to want to make money selling electrons. If you think about Elon Musk's political posturing in public, I can't see that really helping him getting a proportionate share of the funding from the infrastructure bill. Reality is he's probably going to get a minor share, and the other network operators are going to get a major share, or else he wouldn't even be playing to open up the network to these other OEMs. To come back to Tesla, there's credible reasons to believe that there was forced labor, UFLPA, CBP impoundment in the last few weeks in North America. So Richard Mojica, who was intimately involved with this on the solar side, has kind of rung the alarm. And, law of large numbers says it's probably Tesla. When I look at the fact that they changed the reimbursement rate, the federal reimbursement rate from the rear wheel drive Model 3, now this is their highest volume vehicle in North America. It went from $3,750 to $7,500. That means the Chinese content in the battery, which was coming from China ATL, has changed or will change. It's hard to see them switching to a North American supplier being accretive to earnings. And that does speak to risk in their supply chain and risk around deliveries. This is a developing story right now. It's obviously a very sensitive subject, and Richard Mojica has actually just decided to hide after ringing the alarm bells. But Tesla, I think, is misunderstood. So, that's the job of an analyst. That's why I'm able to, add value for my clients, is, being able to put the pieces of the puzzle together and, show people the real sources of information to understand the ebbs and flows in the sector.
So, Craig, just going back out to about a 30,000-foot view, for Ford and GM, them now partnering with Tesla, does that make their automobiles that much more attractive to potential car buyers?
Absolutely. It makes it easier for their car buyers to get out there and charge them. So they're going to get an adapter for the next few years until this is onboard technology. They're going to be able to roll up to one of these Tesla superchargers, put the adapter on the end of the end of the charging cable and plug it into their car. It just made everything easier for their customers. It's a much more interesting, compelling charging experience. The Tesla owners speak very highly of the superchargers. Tesla's executed impeccably there. It makes sense for both Ford and General Motors. I commend both companies on this action. I often think Elon Musk uses things that are, I would call, misnomers for what he calls different things. But NACS, the North American Charging Standard, this is looking more inevitable now that we have two icons of American automotive production joining Tesla here. Very positive for the customers of those two companies.
Craig, thanks for being here this morning. Have a great weekend. Craig Irwin is Roth Capital Partners Senior Research Analyst.
Thank you.
Coming up, from trash to treasure, how AI could change the waste management game. That's next. Here at Yahoo Finance, we've discussed how generative AI could change everything from drug discovery to customer service. What about trash? Jefferies analysts have been examining how the emerging technology could affect different industries going forward, including the business of waste management. Let's bring in one of the authors behind the recent note that looks at the possibilities here. Stephanie Moore is an equity analyst at Jefferies. Stephanie, thanks for being here. And I guess, right now we kind of have to think about this, right? How it could affect really a huge swath of different businesses. You're looking at the business of waste management. One of the most intriguing things I thought that you guys look at is how you figure out which trash goes where. How can AI help with that?
No, absolutely. And good morning. I think, making predictions about the impact of AI, it's almost like going back to 1995 and Katie Couric making predictions about how the internet will impact the world. But I think, the message I'd like to just convey is that the ultimate consequence of AI, I can promise, is something that isn't even on our radars right now. But the sectors and the companies that are early to leverage AI with their existing operations and think outside their current scope of work, those will be the ones that will come out with a product or a revenue stream or a margin profile that no Excel file on Wall Street is even contemplating right now. Except for one maybe generated by ChatGPT. So when you take that a step forward and you think about the impact of the waste space, right now, these companies, they're already using AI and partnering it with video telematics, and they're able to scan through trash efficiently and distinguish, hey, that's a Starbucks cup, that can be recycled. Right now, this is increasing throughput. It's resulting in a cleaner and higher valued product. But really taking it to the next step, it's beyond just recycling. AI can find a use for your trash that you didn't even know existed. And that's the point. AI takes away all these preconceived ideas. How do you find a use for something that everyone else thinks is waste? And that's kind of the point. And the ability to leverage that and say, hey, maybe this apricot peel, or maybe this, these crayons that we're throwing out, these can be used elsewhere.
And even in terms of sort of tracking where some of this waste ends up when it does end up in landfills, you have certain countries taking on more of other countries' waste than others. Perhaps more corporate responsibility could also be highlighted in where some of these products end up. No, and I think that's a very good point. Effectively, you have this instance where, disposing of people's waste is one profit stream, but indexing that waste and creating a data repository, that's taking this to the whole next level. So that's where not only can you identify who's generating the waste, and that's one potential profit stream, but even taking that a step further and just thinking about that, knowing what is being thrown away, when it's being thrown away, by which zip code, which day of the week. The data that comes behind that is significant. And think about what can be used to predict demand, predict shortages.
And so now, from this point going forward, where's the timeline kind of net out? What can we expect in terms of when this will actually be a reality?
No, it's a good question. And I think, like I said, right now, AI, it isn't new. And these companies, the larger waste management companies, they're already leveraging it to their advantage. They're making these investments, and you're seeing that particularly as they sort waste. They're either going landfill to a recycling facility, taking it to the next step. And that's the unknown. And that's the excitement part that isn't reflected in models. It isn't being reflected in these stocks right now, is what they can do with this waste ultimately. And that's probably the next step. And quite frankly, it's coming, and it's likely coming pretty quickly. Because it's only really the next step, the next iteration of what's already being done. The data opportunity, that's probably, a bit longer out on a horizon standpoint. But quite frankly, as we know, creating content at this point and having data and the ability to effectively harvest that data, it doesn't take long for that all of a sudden to be able to be, properly utilized and, more importantly, monetized.
Stephanie, which companies are starting to do this? It's not a huge industry, the waste management industry, in terms of publicly traded companies. We were showing some of them up on the screen. Do you feel like this is something that is going to help the industry overall, or do you think that some of the players are poised to win more than others?
I think it's going to help the industry overall. Quite frankly, you do have, the benefit of the waste is, to your point, it's not a very large industry right now, but it has consolidated, and it has consolidated over the years. And quite frankly, it's becoming more difficult for the smaller players to compete. And this is even before AI. It's just become more challenging. So you have the Waste Management, the Republic, the Waste Connections, the GFLs of the world that are getting bigger. And with their scale, their access to the capital markets, their pretty substantial free cash flow generation, their ability to invest and use CapEx, that they're the ones that will be able to make this change and really benefit.
Stephanie Moore, Jefferies equity analyst, thank you so much. We actually have to leave things there on the day, but we certainly do appreciate you taking the time here with us.
Absolutely. Thank you so much.
Absolutely. And coming up, more markets ahead, and we'll be talking the Live Golf PGA merger. Coming up in the next hour, we'll be taking a deep dive into the shakeup in the golf world. The Live Golf PGA Tour merger is teeing up a new future for the sport of golf and sets up Saudi Arabia as an international player. Here are just some of the thoughts that we got from our guests on the implications of the deal. What we have is a merger between PGA Tour and Live Golf. The Saudi Public Investment Fund will be bankrolling a large portion of that new league to create sort of this big giant golf conglomerate. You can see golf stocks today have actually popped on this. Callaway golf stock up about 5% on this news. It seems like the market overall for golf stocks is bullish on this for the industry.
We need to see ultimately the reaction, how this plays out, but I'd call this, just as a huge golf fan, an absolute shocker.
It is hypocrisy. On the Live side, to your point, it was all about, well, we're offering competition here. There's only been one entity. And then on the PGA side, it was about the Saudis. It was about the 9/11 families. It was about, we would never go near that. At the end of the day, it's business.
To apply it to markets, we are seeing that there is a smaller and smaller handful of companies that are gobbling up everything.
I was as shocked as the rest of the world yesterday. I still have to say I don't fully understand either the process by which this happened or the premise of it, especially given that the tours were already under a bit of regulatory scrutiny for antitrust related issues. This seems to only potentially exacerbate that.
From a business perspective, this was kind of always how the story was going to end as long as Saudi Arabia stayed interested. You cannot compete with an entity with limitless resources and expect to come out on top if your measurement is by dollars and cents.
This was all about money. I don't think it ever was anything else. The PGA was put in a pretty bad spot. Maybe they put themselves in that bad spot. They couldn't afford the lawsuits. They couldn't afford the growing purses. And unfortunately, to some extent, they were in a position where they had very little option but to do this merger.
This PGA merger, it's designed not only to diversify Saudi Arabia's economic holdings, but also to help its image internationally. And that's also important to Saudi Arabia.
And stay tuned for our panel, The State of Play, the LIV Golf PGA Tour merger. That's next.
News that the PGA Tour will merge with LIV Golf shocked the golf community. The two organizations spent the past year in a very public feud. The pivot from friends to foes is truly a 180. Well, tour players were offered astronomical sums of cash to sign on with LIV, dwarfing the earnings some of them may make in an entire career. The PGA Tour accusing LIV of leveraging the game of golf to, quote, sports wash the recent history of Saudi atrocities. Now, LIV golfers were also barred from participating in tour events. LIV players fired back at the PGA with an antitrust lawsuit. As we follow this story here, with that disruption and distraction, as the PGA calls it, it's now behind them. Pending litigation has been put to bed, and the two leagues will apparently move forward as one. Now, there's a lot still up in the air. I mean, what will become of staunch LIV oppositionists who turned down eye-watering payouts to stay loyal to the PGA Tour? Where will these matches be broadcast, and why is Saudi Arabia so interested in the game of golf? Our Brad Smith, Akiko Fujita, Ali Kanal and Josh Schaefer are here now to rummage through all of this mess. Brad.
Yeah, thanks so much, Rochelle. Well, we're not going to really dilly-dally here out of the gate. There's kind of four main ways that we wanted to look at this. And, of course, kind of bringing it back into the business perspective, of course, there is the reaction from the broadcasters that already had deals with the PGA. There is the tax status that the PGA had that had been called into question and really pushed forward some of that litigation as well on the legal front. And there's the player reactions as well, plus, of course, sport washing claims and allegations that have come forward, especially considering where the money from LIV is coming from in the Saudi Sovereign Wealth Fund as well, and PIF. And so all of that considered, it's interesting where we should start off this conversation, because if we follow the money and start there, Kiko, and I know you've been looking at where particularly that funding is coming from and what the history of some of the funding from Saudi Arabia has looked like, even into some U.S. entities and other sports leagues before, too.
Yeah, I've been looking at this from the Saudi perspective, and the first thing I thought of when this came out was sort of the Vision 2030 that was laid out in 2016. Yeah. Crown Prince Mohammed bin Salman saying that, look, we're going to try to diversify the Saudi economy away from oil. I was looking at the budget right now. We're talking about more than 70%, roughly 80% of the budget still comes from oil exports. They have been trying to push to diversify in other areas, bring investments domestically. That hasn't necessarily worked. And we've already seen this kind of in the tech sector we shouldn't say buying their influence, but investing in these tech companies, whether it's Uber, whether it's Lucid. So the Sovereign Wealth Fund has been putting a lot of money there. What's interesting to me about this story is that, yes, it's been happening on the tech side. On the sports side, a lot of that has been abroad. And this sort of brings it all back home here in the U.S. when you talk about really getting that stake in golf.
And they sort of found a good loophole when you think about the PGA and you think about golf as an overall sport, right? Because you can lure big players away and almost make the PGA worthless without actually buying the PGA, right? When you buy Uber, you have to buy shares of Uber, and eventually you would have to actually be approved to buy the whole thing, right? And shareholders would have to vote for that. Shareholders in the PGA, I guess we could call them the players, don't really have to vote at least all in one. You take a couple big name players and you really start devaluing what the PGA has. And I think it was sort of a smart, savvy business play when you think about, I think my read from this from the beginning was LIV Golf was never actually going to be a league. The Saudi Public Investment Fund wanted to get into American sports and they wanted to get into the sport of golf. And they successfully did that with this investment.
Yeah, and you have to feel for the players that rejected those LIV Golf contracts, $100 million reportedly for the sanctity of the game, to be loyal to the PGA. And now you have this merger, and no one really knows what this is going to look like. There are little details right now. And even on the broadcast side, you were mentioning some of those deals. I mean, the PGA contracts, they currently last through 2030 with ESPN, NBC, CBS. They're worth more than $700 million in domestic TV and streaming rights annually. And this is something that LIV Golf really needed. They needed a domestic deal. They were able to strike a multi-year partnership with the CW. But that was an odd network choice as well, because it skews younger female demographic with shows like Riverdale, The Flash, Supergirl. Your target audience for golf isn't necessarily going to the CW. And then on top of that, you had really struggling ratings for those broadcasts on the CW. That Mexico season opener in February, just over 500,000. And then we saw a 24% drop in their second event in Tucson. If you compare that to the PGA, its latest event, the Memorial Tournament, saw over 3 million viewers tune in to that final round on CBS. So there's a big discrepancy there as well.
So you point to, why so many players were outspoken against LIV Golf. And I think it's worth mentioning why, because that sort of puts all this in perspective. It's not just about the sport. When you talked about the sanctity, it is about what Saudi Arabia has been alleged in terms of atrocities. It's about the war being waged in Yemen. It's about the murder of Washington Post columnist Jamal Khashoggi. I mean, there are so many issues. Remember, 9/11 families came out and said, look, Saudis were behind the attacks here. And now you've got a massive sovereign wealth fund, the money there coming from the kingdom directly, having a stake in it. And you have to wonder what this means, because, Josh, I know you've been looking into this too, but are they going to go for another sport now like the NBA? And are the...
Yeah, no, I mean, they could. So the reason we highlight the NBA, too, is because the NBA has said that they will accept money from sovereign wealth funds. Now, Adam Silver has actually asked directly about this recently. The NBA finals are ongoing right now, so the commissioner is being interviewed quite frequently. And he said they haven't directly seen investment from the Saudis yet or seen interest yet, but sort of tiptoed around, well, they invest in a lot of other things, and think about the World Cup in Qatar, and people sort of eventually overlook these things. And I think that's kind of the lesson here, Brad, is we talk about the atrocities, but at the end of the day, these things keep happening, right? We keep seeing these investments, and really what can we do when people eventually just want to take the highest bidder, right? They want to take that money.
And for anybody who's tracked the world of golf, Saudi Aramco already had a series on the women's side for the better part of 2-3 years now. They've been able to move that forward. And so that's kind of going with what you're saying, and people just looking past it saying, well, yeah, women's golf needed more money anyway. Why not allow them to make this investment? And if we're coming back to Jay Monahan and a lot of the decision making in the dollars that went forward around this is, whether we want to call this the best or worst business decision or executive decision he's going to make, time will tell on that. But what we do know about him right now, in the messaging that he moved away from, it was hypocritical to what they were putting out there in rebuke of what Saudi Arabia was doing with launching Live Golf and the funding that they were putting towards it and the $800 million sums that they were willing to offer reportedly to Tiger Woods and other major players as well.
PGA needed money, right?
Right.
The PGA mainly operates as a nonprofit. They were pulling a lot of money and a lot of funds to try and get more money into these tournaments. You think the Memorial Tournament a couple weeks ago, they paid, I think, $3 million to the winner. That winner used to get $1.5 million. They were boosting these prize money pots so people would stay in the PGA and not go to Live. That's not a sustainable model when you're not, this isn't the NFL. We're not talking about billionaires that own teams and are funding the league. That's why the PGA was such a smart play for the Saudis. There is not billionaire money involved in this league.
And not just the money angle too, right? But also the international exposure, because we've seen the domestic viewership steadily be on the decline for the PGA. They've struggled with viewership. The final round of the PGA Championship in May was the lowest total since 2008, 4.52 million, down 14% year over year. And the first final round since 2019, where it did not reach 5 million viewers. So you have to wonder if there is this lack of relevancy in golf as a whole. I know, Brad, that you picked up on that because you're a big golfer, but it's an older demographic. There's a lack of diversity. It's very expensive. There's a lot of barriers to entry. Exactly. And Live, it seemed like, wanted to really appeal to the Gen Z of it all and make it more exciting and just crack the mold, I guess, of what we traditionally think of.
But is it really about that, or does it just come down to money, like you said? Because we know the Saudis have a lot of money, right? And I wonder where is this just about golf, or do they pursue other sports? And if that's the case, where does that comfort level lie? I mean, I'm sort of looking at this from a geopolitical prism, right? If it is PGA and Live, sure, we don't expect regulators potentially to step in. It's golf. If it moves into the NBA, if it moves into the major leagues, does that point bring in lawmakers who say, oh, wait a second, let's maybe put some guardrails up for what that foreign investment should look like? We've already seen that in the tech space. Is sports a big enough thing for this to become broader beyond the sports conversation? Is it going to bring in regulators? Is it going to bring in lawmakers to say, we don't want that much Saudi influence here?
Yeah, I'm not even going to give credence to the argument of whether or not golf is a sport. I would say yes.
Well, it is a sport, yes, of course, but is it big enough?
Exactly. And at the same time, even as we think about the gatekeepers of golf, they have almost been the worst detriment to golf and the growth of the sport, I'll call it, and the fact that you've had leadership sit idle for so long and allow for a totally new league, and not just one, but 2 or 3 other leagues around the world internationally be able to get legs and be able to get viewership and slowly siphon off, to your point, some of that viewership that the PGA could have gotten if they would have become more innovative, if they would have listened to the fans saying, you know what, we want more events like Waste Management Open. You know what, from the fans and the players, we want more of the ability to just not have these stringent rules that loom over the game to make it so that it's not fun. Nobody wants to engage either as a fan or a viewer or a player in a sport that they say, so what can I do? How can I get to the goal line? How can I make sure that I get the ball in the cup at the end of the day when there's so many rules? That's what their issue has been for a while as well.
That's why I think both sides sort of conceded here, right? In the sense of Live didn't succeed. We were saying that they got a streaming deal with the CW, but really they didn't want a streaming deal with the CW, right? That's a loss. They couldn't find a real streaming partner that was actually willing to pair up with them at a high level, a big streamer that we talk about and cover here, like an ESPN or something like that. They were never going to get that. No. But then PGA also sort of admits Live had good ideas. Not only did they have money, but maybe the guys can wear shorts. Who really cares if they're wearing shorts? Who really cares if they ride carts I think people would love if the PGA allowed carts, because then the most popular player in the PGA would be playing weekly right now, Tiger Woods, who can't walk in between holes.
Well, you went to one of the live golf events, one of the earliest ones in the U.S.
And some of the people, I went last July out in Bedminster.
Was
at
it
Trump
fun?
National.
Was it like Waste Management?
It was golf but louder, as they said, because they played music the whole time.
And that's like the only thing I know to refer to.
So let's take the source of the money aside.
Yeah.
Ultimately, is this good for the sport? And then does it matter if the money comes from the Saudis? I mean, let's talk about golf itself.
Well, it removes a headache here, and you've seen that in the stock price reaction as well. I was taking a look at Topgolf Callaway, and that is up 5.5% just since this deal was announced, just over the course of this week. You've also got Titleist owner Acushnet. That was up by about 5.8% this week. So there's clear reaction in the manufacturers of the equipment in golf, knowing that there's this overhang that, man, we don't have to worry about that anymore. Now we just have to figure out, okay, for our players that are going to be in this newly merged league, how we support them and continue to support them best.
Do you think Live Golf can make a star out of some of these players? Because that, to me, is the biggest issue. Tiger Woods, obviously, but he's getting older. I feel like golf doesn't have a go-to star that can really drive.
But is that
the
PGA Live's fault, or is it about finding a rising star?
I would blame the PGA. I would definitely blame the PGA for not compensating players at the level that they could have been, when you can have and create stars that way, right? And sort of create by paying players more to show up at events, and paying players more to play more, and paying players more that play well. So understanding that they're the people that are driving ratings, it was a big argument from players throughout the years that saying, basically Phil Mickelson said, when I show up to a tournament, that's why butts are in seats. I should get more money. And the PGA never really did that until Liv pushed them to do that.
He's old too.
Well, he is.
Younger players.
But he played well at the Masters. We'll give him that. Hang on, just 1 second here, because I think there is, and we didn't get to play the clip from Rory McIlroy, but if there's one player that has emerged as perhaps the new face of golf, for better or for worse, because now there's going to be a conversation around him all the time. And I think we do have the clip, so we'll run in a hot second. But Rory was the poster child for the PGA's claims against Liv. And now this deal comes forward. Here's what he had to say right after that deal was announced.
I see what happened in other sports. I see what's happened in other businesses. And honestly, I've just resigned myself to the fact that this is what's going to happen. Like, it's very hard to keep up with people that have more money than anyone else. And again, if they want to put that money into the game of golf, then why don't we partner with them and make sure that it's done in the right way?
So the money spoke to Jay Monahan, and Jay Monahan didn't speak to Rory, even though he was pushing him out there throughout much of all last season, the season prior, and Tiger Woods bringing in all of these people to make sure that they were pushing the PGA higher, but at the same rate. At the end of the day, it just comes back to this deal.
Money talks.
Money talks.
Yeah, that's the big takeaway.
That's the business lesson here, right? You're never really going to win. Your boss can do whatever they want. They can go and make a deal behind your back. People are going to chase the money. You can try to not chase the money if you want to, but at the end of the day, someone will chase that money. Someone is going to get that money. So if you want it, you should go get it.
And be a part of the conversation? I mean, is that kind of what it comes down to?
Right. You probably would have had a seat at the table, right? It seems like Phil Mickelson at least alluded to he had an idea that it was coming.
Yeah, absolutely. All right, guys, we got to wrap things here right now. Thanks so much for joining us for this conversation. PGA and Live Golf, they are going to be a newly formed unit here. That merger announced this week, and a lot more following the money that we'll be doing from the Yahoo Finance perspective. Thanks so much, guys. Rounding out this panel, Kiko Fujita, Ali Canal, Josh Schaefer.
All right, great stuff there. Following the money. That's how it ends, Josh. You said it. A big thank you to them. We're going to give you a quick check of the markets before we go. We're seeing all three major indices in positive territory. We're seeing the Dow here up more than 100 points, or 1/3%. The S&P also seeing strong gains there, up about 0.5%. The Nasdaq up about 100 points on the day. A lot of movement there on that merger.